Well, in this video, we are concerned to understand not the definitions and the difference between the working capital and the finance capital and the fixed capital, but we are meant to understand the strategies that businesses adopt while managing the working capital management. In a nutshell, just we will quickly take a look. Working capital is the amount which is used to cover all of the company's day-to-day operations, short-term expenses, okay, which are falling due within 1 year period of time, not beyond of the 1 year period of time. Because if we talk about beyond 1 year period of time, then we are meant something, something else which is known as the fixed capital. But working capital is the difference between the company's total current assets and the current liabilities. Working capital is used to purchase inventory, paying short-term debt, and day-to-day operating expenses. Day-to-day operating expenses like paying wages and purchasing short-term inventory and paying some freight charges and some other related activities of the businesses which are falling due on a day-to-day basis. Long-term sources of working capital. Long-term working capital sources include long-term loans, provisions for depreciation, retained earnings, debentures, and share capital. Here we are concerned with the short-term working capital sources, including dividend or tax provisions, cash credit, public deposits, and many others which are there. And again, the uses of the working capital, as mentioned in the previous slide also: buying the inventory, paying short-term debts, and day-to-day operating expenses, which are very important for this working capital management. Now the thing is that what businesses do in order to project their operating needs, operating expenses, and how do they define their strategies to manage these short-term or long-term sources of funds in order to meet their day-to-day business operations. So there are many strategies in the working capital management. The first strategy that I am going to discuss is known as the hedging strategy. Hedging, or you can say some different names are also there. We will just take a look how does this strategy work so far as working capital management is concerned. So here we will see, like for an example, the strategies. When a business gives a projection, say in the month of January, February, March, April, May, June, July, August, September, October, November, and December. Okay. For an example, they think, or any business think, that the working capital requirement, okay, will be in the month of Jan. For an example, say 12,000 in the month of February, 10 again in the March month, 10, then again 12. This is all my assumed figures which I am taking here. And here, for an example, say 15, and here again 12, okay, here 13, here 10, here 12, and in the month of December, for an example, say 18. Okay, so these are the permanent projection plan given by the manager, that in the month of Jan the working capital requirement will be like this. Okay, this is a working capital. This is the amount which will be required in each month, okay, on the permanent basis. Now we will take a look here that what are the amount which is permanently required at least in that month. At least amount, the least amount which is required, which we call here as a say permanent working capital required in each month. That is not gonna change, but at least 10,000 rupees will be there, which will be required by the business in each month. Okay, so we are just doing nothing, we are just mentioning here that these 10 months will be required in each month, in no matter whatever the situation is, 10,000. Okay, so that permanent requirement is there. Okay, now what is left? This the beyond of that amount which is required is known as the seasonal. So for an example, 2000 excess will be required in the month of Jan. Here there will be no requirement, here there will be no requirement, here again 2000 will be required. Here in the month of May, 4000 additional capital or additional working capital will be required. Here 5000 will be required, here 2000, here 3000, here no requirement at all, okay, and here again 2000 will be required, and here 8000 amount will be required, okay. So this is what we are concerned to calculate the cost of acquiring the short-term debt in order to maintain the permanent working capital. This permanent working capital, because we have taken the least amount here, and which is known as the part of the hedging concept is there, okay. In some of the books, if you will go through, you will find the same hedging concept will be given as matching concept. Here businesses, most of the businesses, they adopt these strategies in order to meet out their monthly requirements. So whatever amount we have taken here, we have taken for an example this 10,000, 10, okay. In all the months we at least need this much of amount. So just quickly take a look here that for an example here, so we will just go to the next slide, and let's say here yeah, so 10,000 is the requirement falling in each month, okay. I am just writing here, in each month company needs at least 10,000. So in total 12 months, how much? 12 months they need to have 120,000 rupees additional capital which is required. For an example, company goes for LTS, and I'm writing here the short-term sources, long-term sources and short-term sources, because this is their need for long-term, because in the whole month they need to have at least 10,000 rupees in as a part of liquid money, in order to meet out their day-to-day operations, day-to-day operating activities, okay. Just take a look here. I consider here at the 8% LTS and short-term sources 4%. I'm telling you this concept will come later, but initially we are going to use this long-term sources. Cost of debt is 8%, okay. So this 120,000 is taken for 8% debt. That means 9,600, okay. 9,600 will be taken as a part of the total cost in a year, in 1 year, okay. In then their monthly cost, we will just look here, the monthly cost will be how much? 9,600 divided by 12, which will be 800 rupees, okay. 800 rupees. Now we will see that what was the additional, the seasonal amount. See in the previous slide, this 2000, 4, 8, 13, 15, 18, 20, 28,000 requirement is this, okay. This 28, I'm just writing here 28,000 for 1 year seasonal working capital requirement. And if you will take a look here, so approximately 2300 will be the amount which will be required to maintain or to meet out their seasonal working capital requirement from January to December. This is the average I have taken, okay. This is the average. So 2300, and I have considered, and we will take it on short-term borrowing. This 2300 will be 40040 divided by 100. Okay, so 92. So 800 cost will be from long-term sources, and this 92 from the short-term sources. The overall cost will be 892 rupees only. This will be the total cost adding all the long-term sources and the short-term sources. Now we will just try to find out that what is the advantage. Okay, what are the advantages by doing all such procedures? Because by this thinking twice, and in order to maintain the in order to lower the cost, so what are the advantages? We will define it in the four aspects: the cost, profit, risk, and liquidity. Okay, just see in the next slide we will have to move. If we move there, we will see that what are the points that I have discussed here. By applying the hedging concept, okay, it will impact on the cost, it will impact on the profit, it will impact on the risk profile of the company, and it will also impact the liquidity. So since the cost I have defined, how much cost incurred? 892, and the cost is very less. If you will consider the overall cost in a month, it is merely 892, which is very less. Okay, the cost is less, so obviously the profit will be more, and we will just see the what will be the impact on the risk profile if we follow this hedging strategy. Okay, if we follow the hedging or the matching strategy, because in most of the books you will find hedging, and some of the books you will find the matching strategy. Okay, so don't get confused, my students. Strategy. Okay, the risk, what will be the impact on the risk? The risk will be highest. Why it will be highest? Because we are paying attention towards maintaining the lowest among all the months, 10,000, 10,000, 10,000, and we make it as a permanent requirement of the working capital. Okay, permanent requirement of the working capital, we have taken how much? 10,000. That is why here it will be the highest risk involved. Highest risk involved. Why? Because of this seasonal working requirement. For an example, if any movement due to some unforeseen events, some contingency, suddenly the seasonal working requirement goes so high, so how you are going to meet the this requirement so soon? No matter whether you are offering the long-term sources and paying 8% or higher percentage of the debts, okay, that is still there will be the highest risk. Since you are maintaining the very less amount of the liquidity, because every time you are very close to the requirement, 10,000 every moment, every time you are just how much maintaining? 10,000. Okay, so that is why there is no question of having the high liquidity. So the liquidity amount will be lowest. Okay, if we compare, and then in the next video we will compare this strategy with the traditional strategies. Traditional strategy is little easier from this strategy, because in the traditional, I just give you the concept of the traditional strategy. In the traditional strategy, we just see the requirement. Just let me open it, and then I'm gonna explain it. 1 minute. Here, see here, in this way, how much we are taking in the hedging way? 10,000, 10,000, and we are making it average 10,000 in each of the 12 months, okay, from January to December. When we opt for the traditional strategy, so we will see here that in which month the highest working capital will be required. So highest working capital is required in the month of December. So instead of taking this 10,000, we will take here in the traditional way 18,000 requirement in each month. No matter in 1 month only 10,000 is required, but you are accumulating, or you are trying to get it 18,000, 18 everywhere. Only this way you do not have any working capital requirement. Traditional way is bit different from the hedging concept. Okay, so we, in the next slide, we will discuss about the concept of the traditional strategy in order to maintain the working capital.